let's do a valuation practice example. We've got a company here. We've taken its information off of its uh, um, annual report. All the numbers here are in thousands except per share. So EBIT is 78 million, not 78,000 as it is here. We just truncated 3 zeros basically. The formula that we're looking for is down here, free cash flow. Free cash flow is the amount of money that would be available to the owners. So free cash flow is NOPAT, which is net operating profit after tax, minus the change or the difference in working capital and net fixed assets between this year and last year. So if we go through this, EBIT, and the tax rate is 25%. To get NOPAT, we find that NOPAT is net operating profit after tax is the EBIT, earnings before interest and tax, and then we subtract 1 minus the tax rate to get after tax money. So we've basically got 75% that's left over after paying the taxes is the net operating profit after tax. We have T, which is the previous year, and which is time. T is time. And then T plus 1 is one more year. So this is the previous year. This is last year. This is this year. Then we have information from the accounting statements. Cash, accounts receivable, inventories, which adds up to the asset total. And then accounts payable and accruals. In this case, we don't have any accruals, which adds up to the liabilities total. And if you add those two up, you get our net working capital, which is assets minus liabilities. It shows our net working capital here. And then your net fixed assets, this number just comes off of the balance sheet. So this is how much plant, property, and equipment they have. And this is the net working capital, is how much financing and how much money is in the company. So there's 65 million in net working capital, and there's 98 million in plant, property, and equipment. So the value of the assets of the company is 163 million 685 this year. Last year it was 119,264. So we had to invest quite a bit into this company to see these new sales. So the difference between these two numbers subtracted would give us our working capital, our change in working capital and net fixed assets for the year. And of course we're going to subtract NOPAT, that from NOPAT, or our net operating profit. So this is how much money we earned this year. And the difference between these two is how much money we had to put back into the company to keep it running and earn that money. So if we look at our free cash flow equation, we simply take C7, which is the amount of money we earned, and then subtract the difference between the 2 years, which we had to invest in the company to keep it going. Clearly, a company is going to need new equipment. It's going to need new ongoing, maybe it needs more people. It needs all kinds of things that are going to cost money. So we need to reinvest into the company. So the difference between these two in these 2 years is what we had to reinvest in the company to earn this amount of profit. So we use C7 minus C19 minus D19. Don't forget the parentheses, and we will find the free cash flow. Free cash flow here is the amount of money that we get to keep. Now, this is what shareholders like, because free cash flow means that is how we value our company. Now, we take that free cash flow and we just do a quick NPV to get a price per share. So at times 0, which is time today, we have this free cash flow, and we're going to make some assumptions. The assumptions are for 3 years, this cash flow goes up at 6%, and then forever on, it goes up at 3%. So we're growing, 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 and then it flattens off, and we get basically the level of inflation going forward. So the easy calculation here is we simply take C22 into this cell, and then the next cell in D26 is simply C26 times 1 plus the increase in the cash flow. So that's a pretty easy calculation. You just simply increase it by 6%. And then the next calculation is going to be exactly the same, except you're going to increase the next year by year 1 by 6%. And then the final one, I've done a couple of things here that you need to pay attention to. The first one is I have put this calculation for year 3 below the total. So you can see here that this calculation is the same as year 2 in that I took the previous year and I multiplied it by 1.06, or 1 plus the increase in what I believe the cash flow will be in the future. That's one calculation I did. That's this calculation. The next calculation I did was to use the growth formula. And the growth formula is D1 over K minus G. And so when you look for D1 over K minus G, we take, this is D, this would be times 0, or D. This would be 1 period more, and we increase it, D1, by whatever our growth rate is. In this case, it's 3%. So we have done that here to get our number for D1, and then we divide it by 1 minus the discount rate minus the growth rate. So in that case, we have D1, which is G26. G26 represents the next period dividend. This is the year 4 dividend, or the year flow cash flow. And then we divide by B26, which is what we could have if the company wasn't going to grow. But the company is going to grow, and it's going to grow at 3%, which means we have to put some money back into it. So G24 is the 3% that's going to continue along with the company. And so we have D1 divided by K minus G, and in this case K is 5% over here at the discount rate, and G is 3%, which is the growth rate. So if we do that calculation, we see that we get 894 million. So what this represents now is 894 million is from the end of year 3 in perpetuity forever. The 17,360 is for year 3, 16,337 year 2, 15,450 for year 1. So 15,450 is this year, and 16,377 is this year, and 17,360 is year 3, and then everything beyond the end of year 3 to perpetuity is 894 million. So I've taken 911 here, is the 894 plus the 17,360, which both occur, or both are, at the end of year 3, beginning of year 4. So we just add them together. So we have 3 years here, 15,540, 16,337, and 111 million, and we discount those back at our discount rate, and we find that it's 866. So as you can see here, I've just simply equal NPV, parentheses, discount rate, comma, that's the rate. Then we have values. The values are these 3 values. That is our future cash flow values, and we discount that back so we know what it's worth today. So what the company is worth today is $816 million. So let's put it in different terms. Let's flip it around. If you deposited $816 million today, you could withdraw $15,450,000, $16,377,000, and $17,360,000, and then the next year $17,880,000, and then up 3% in perpetuity forever. If you deposit 1866, that's the value of this company. You will get all that future cash flow. Now, obviously, we already have the 4,576 because it's in the numbers. So that year 0 doesn't count; it's already in the numbers. So we've got these 3 years, this year, this year, this year, this year, and then we just keep going. And when we keep going, it's going to grow at 3%, and we would be able to have that cash flow in perpetuity if we invested $816 million today in this company. Well, so 816 sounds like a lot of money. I don't want to invest the whole thing. So, and that includes debt, right? That includes debt. So the first thing we do is subtract the debt. This company has no debt. So I just easily make it easy. It has no debt. So it's all going to the shareholders. If there was debt, you'd simply subtract the debt off of this. So the value of the equity portion is 816. And of course, since we don't want to buy the whole thing, maybe we only want to buy a little bit of it, we divide by the number of shares. And so the number of shares here is 10,000. It's not actually 10,000, it's 10 million shares, right? Because we're all in thousands. And so 816 divided by 10,000 gives you $81.69. So your portion of this $816 million with 10,000 or 10 million shares outstanding is $81.69. So you would pay $81.69 per share. You could get your prorated total of 15, 16, 17, 17, 17 going forward forever. That's what this value represents. That's the value of the company to the shareholders. Now, all we would have to do at this point is to look in the market and say, oh, the stock price is at $74. And the stock price is $74. I believe it's worth $81. So that sounds like a pretty good deal at 74. So maybe I would buy it. If it was 104, I'd go 104. Wow, they must think this growth rate is either bigger or the perpetuity will be higher or so on. They must believe something else. Or they could use a different discount rate. So if I change this discount rate and say 0.06, I get a completely different answer here. In fact, if I do 0.08, I get a completely different answer here. And what the discount rate represents here is the return you're expecting on your money. So if you want an 8% return, you'd only pay $32 for this share. If you want a 4% return, you'd pay $163 for this share. So it all depends on how risky you think the share is. Obviously, if it was a biotech stock that's trying to cure cancer, you'd say, well, I need 30%, and I'd only pay $5.96 because I don't believe these cash flows will come true. On the other hand, it could be something guaranteed locked in, such as a something that's very straightforward, say as Pacific Gas and Electric. You know, they're not going to go out of business. We're not going to get rid of electricity. So maybe PG&E would be at 0.04, and you'd say 4%, and that would be worth $163 a share. So the discount rate is what return you're expecting on the investment. And so you start thinking to yourself, well, I want a discount rate. I think this is risky. I don't think I'm going to get my money back. So I want a higher discount rate, and then you'll get 8%, or put in even higher. You could put in 12%, and now you'd only pay $18 for the share. So you can see how the discount rate impacts price here. Now there's another way to do it, and I alluded to this in class. I'm going to go back to 0.05, so we have the same answer we started with. 0.05, 81.69. There's another way to do it, is instead of putting your own discount rate on it, just back into how much the market is discounting it back. See what the consensus of the market is for the discount rate. Now the way you do that, the easy way to do that, is I've done it here, is you set up a table at where the discount rate would be and what the different price per shares would be. So if you go here to 5% and you go here to 5%, you can see it's 81.69. Now the way I did this was I simply took this value of the equity of 864 and calculated the new net present value. So I've got a new net present value here, and I took that and I did it for different discount rates. So I just calculated for all the discount rates. As you see in this 864, if you notice, everything's a dollar sign, doesn't change, except for B35. B35 is this cell here. So everything, the only thing that changes is B35. The rest of the equation doesn't, and that makes it really simple. And then, of course, this is simply this number does not change, and the C35 does change. So it's basically dividing by the number of shares for me. And once I have that, I can just window in these numbers. Whoops, I'm going to do this. And window them down, and I'll get more numbers. And if I type in and I window this down to get the pattern to continue, I'll continue to get numbers here. And in fact, if I do this, I can keep going and get all kinds of numbers, all for a complete spreadsheet of all the different values at all the different discount rates. So what you would do is, instead of believing your discount rate of 5% is correct, instead of doing that, back into it, simply go, what is the market price? Here's the market price. There's the market price. What's the discount rate? 18%. Do I think this company with this cash flow is risky, more risky, or less risky than other investments at 18%? And if that was the case, you'd go, oh, I think the market must know that it must think that it's more risky than I think it is, because I thought it was only discounted at 5%. I thought it was pretty safe. The higher the discount rate, the more risky it is. Well, if the market's at 57.96 and you're at 81.69, the market must think it's riskier than you do. So does that mean you should buy? That means you should think about it, because they might know something you don't. And if they know something you don't, you need to investigate it. So if you're really far off from market price in your calculations, you would start to look at what is the market discount rate. I found it at 18% here if this was the price. And this 18% would tell me, wow, that's pretty risky. They must think something along the something about this company and its cash flow is different than what I thought it was. It's certainly more risky. So that's one way to look at all these net present values very quickly and easily in a different context, as opposed to putting your own discount value on it and doing your own price per share. So to recap, I'll go through this again. EBIT is going to be a number that you get from the accounting statements, as is the tax rate. Net operating profit after tax is simply the after-tax cost. So it's EBIT times 1 minus the tax rate, which gives you 75%. So it's the money that's left over. And these are two time periods. I put this as the previous year and this as the current year. It doesn't matter which way you do it, as long as you keep it straight. The cash, accounts receivable, inventory is going to be a number that you get from the balance sheet. Assets you're going to calculate. The total you're going to calculate. Accounts payable and accruals you're going to get from the balance sheet. Liabilities total you're going to calculate. You're obviously going to calculate the net working capital, which is simply the assets minus the liabilities. Net fixed assets you're going to get from the financial statements. And of course the total is simply the working capital plus the net fixed assets. Then to get free cash flow, which is the number we're looking for, we simply take the net operating profit after tax and subtract the difference between this year and last year. And if we subtract the difference between last year between the net operating profit after tax, we get free cash flow. Free cash flow is the amount of money we should be able to keep as owners. Now, that doesn't value our company. We have to keep going. That's this year. Next year, if we assume 6% increase, it'll be 6% higher. The following year, we also assumed 6%, and the following year, we assumed 6%. Then the question is, in perpetuity, from here on out, how much is it worth? Well, it's worth the next term dividend. The next term dividend is the 3%. It's this multiplied up by the 3%. That's D1 in the formula. And then, of course, divided by K minus G. K is the discount rate. G is the growth rate. So it's the next term dividend divided by K, which is the discount rate, minus G, the growth rate. And that says that the future free cash flow, 17,880, and growing at 3% forever, is worth $894 million. If we add the 894 to the 17,360, we know at the end of period 3, at the end of year 3, we get a total, and the total is $911 million. So if we discount that back at the 5% discount rate, we get a net present value, these three terms and the discount rate, a net present value of $816 million. To spin that around, 816, if we deposit that today, we could withdraw 15,450, 16,337, 17,360, 17,880, and 17,880 times 1.03 for the 5th year, and then every year after that growing by 3%. We could withdraw that if we deposit that today based on how this company is performing. Therefore, that's the value of the company. If we have borrowed any money for it, we have to subtract that out. In this case, we haven't. So the value of the equity portion, the debt portion being subtracted out, the value of the equity portion is 816. We divide by the number of shares, and we get a price per share. Obviously, the discount rate the growth factors of whether they're near term or long term are going to have a huge impact in it. And one of the ways we see that impact is we can just do a quick table here of different discount rates at different net present values and different values per share. And so we can see that instead of trying to sit here and play with the numbers, if we can just do a table, and this is just a straightforward calculation with the net present value here. And if we leave the dollar signs off here, it's easy to simply drag the formula down and it'll change automatically. So that makes life pretty simple to create a table once you've got the information in and you've got the right dollar signs. So the dollar sign here is what doesn't change, the number of shares. What does change, the value. The value goes down every time and it gets divided by the number of shares. In this, what changes, the discount rate. What doesn't change, these numbers up here. So it makes a very easy spreadsheet calculation. You can just take this and drag it once the dollar signs are put in place properly, and you can drag it all the way to however large a percentage you want and find the current price, whatever the current price is, and you'll know that the discount rate's 22%. In other words, if you invest the amount of money that the company is worth, the company's worth $525 million. If you invest that and bought the company today, you would be earning 22% on your money if these future cash flows came through. So there you have it. You've got a good example of walking through this one problem, this valuation problem. What you should be learning here, obviously, is that financial analysis requires knowing what the company's doing last year and this year and how it's performing. You should also notice that the risk, the amount of discount you put into it, is incredibly important, as is your projection of future cash flows. One last thing is, because it's very difficult to predict future cash flows and the discount rate, you can also back into it by figuring out what the market discount rate is and saying, oh, the market's at 22%. Do I think it's more risky than that or less risky than that? If I think it's more of a sure thing, then I think it's underpriced and I'd buy it. If I think it's less of a sure thing and more risky, then I think it's overpriced and I wouldn't buy it. So that's how you look at a valuation practice or a valuation problem, and this has been practice for you. So look at the examples that I've given you and try to create your own spreadsheet. I will give you this spreadsheet for you to work with, so you don't have to recreate the wheel, but it's important for you to understand how you go about doing things like this so you can do it for yourself in the future. Obviously, I'm always available by text. Call me anytime or text me anytime. I will respond as quickly as I possibly can. Have a great day. Thank you so much.